Hello. In this video, we'll be going through some special issues in revenue recognition, specifically prepayments, warranties, and customer options. You should be familiar with this slide by now if you've seen previous videos on revenue recognition, but companies recognize revenue when the goods and services are transferred to customers at an amount that the company expects to receive in exchange for those goods and services. There's 5 steps that are used to apply that principle, and they are identify the contract, identify the performance obligation, determine the transaction price and then allocate it, and know when to recognize the revenue. In this video, we're going to be focusing on item number 2, identifying the performance obligation. It's not always clear-cut what needs to be done in order to earn that revenue, or what if someone receives money, does that qualify as a performance obligation? So we're going to be talking about prepayments, warranties, and customer options in this video. Let's start with prepayments. And when we say prepayments, we're specifically talking about one type of prepayment, and these are the non-refundable upfront fees for particular activities. And non-refundable is really the key word here. And so think about if you make a hotel reservation or any sort of reservation and you have a non-refundable fee. If you go to Costco and you have a warehouse club enrollment fee that you have to pay up front. Or if you join a gym, right, they say, oh, you have this $100 fee that you have to pay, and then your monthly fee, and that $100 is non-refundable. So the question is, when someone gets that non-refundable upfront fee, how does that get treated when you're talking about the performance obligation? We've learned before that there could be a single performance obligation or multiple performance obligation. So getting that upfront non-refundable fee, is that a different or separate performance obligation? And the answer is no, it's not. When a company gets a non-refundable upfront fee, that fee should be included as part of the overall transaction price and record as a deferred liability, and then you recognize revenue as each performance obligation is satisfied. Let's take the situation of having upfront gym fees, right? If you join a gym and you have a $100 non-refundable upfront fee, and then you have to pay, it's a 1-year contract. Let's just say it's a 1-year contract, and every month you're going to pay $35 to that gym. This $100 will get split into 12 months and then allocated. It's going to be added to this $35 of service revenue each month. But when you first get that $100, the company is going to debit cash for the $100, and they're going to credit the deferred liability. It's a liability, and then they're going to recognize 1/12 of it each month and reduce the liability by 1/12 and recognize revenue for 1/12, in addition to the $35 that you pay as part of your gym membership. Another type of issue that might arise is quality assurance warranties. And these are warranties that come with any sort of product that you may buy that obligate the seller to make repairs or replace the products that are later found to be defective or something's wrong with them. And those warranties are actually considered to be part of the performance obligation to deliver products of acceptable quality. So if I buy, or if you sell a product that costs $100, right, with a 2-year quality assurance warranty, what this is saying is we're not going to break up this $100 between the product itself and the warranty. We're not going to try to break it up and make it into 2 separate performance obligations where on day 1 when we sell the product, we recognize the revenue for the product, and then for the warranty, we would recognize it over the 2-year period. We're not going to do that. So that's what it's talking about. It's just included that quality assurance is just assumed to be it's part of the performance obligation to deliver a product of acceptable quality. So you do not break it out as a separate performance obligation. Now, there's also extended warranties, which are different than the product quality or the quality assurance warranties. And these are customer warranty. They're warranties that customer has the option to purchase separately from the product, right? So think of a car. You buy the car, right? And so when the dealership gives you the car, right, on the spot, that's when they recognize the revenue. They have completed that performance obligation with respect to delivering a car to you. Now, let's just say for that same car, you have the option to buy an extended warranty, right? A 5-year extended warranty that covers bumper to bumper, let's just say. And that 5-year extended warranty is $5,000. And so you pay the $5,000. So the dealer, what they will do is they're going to debit cash $5,000 for that, and credit, again, they're going to credit their deferred liability for $5,000. And then each year, they're going to recognize the revenue from that $5,000. So they're going to debit their deferred liability. This is for each year. And they're going to credit service revenue and on their income statement for $1,000 for each of those 5 years, right? This journal entry right here is going to be in addition to the car itself. So if you pay $30,000 for a car, unlikely you're going to come up with $30,000 cash, but let's, for purposes of this simple example, the company would debit cash $30,000 and they're going to credit revenue for $30,000 because they've already performed their obligation, their performance obligation. They've completed their performance obligation by giving you the car. So they would have recognized revenue for $30,000 and have a deferred liability for $5,000 on the day that that automobile was purchased. Now let's talk about this second bullet point right here. The warranty provides a service to the customer beyond quality assurance. If there's a warranty that you do not have to necessarily pay separately for, but it is attached to that product where the company will assure you that the product that you've purchased goes above and beyond the quality insurance, then the purchase price of that product does need to be separately carved out between the product and the warranty, and each of those will be a separate performance obligation. Here's an example. If a car dealership, usually these warranties, these types of warranties are very long term. Here's another example with a car dealership. You go buy a car for $30,000 and that car dealership says, oh, this includes a quote unquote free 5-year service maintenance package that includes oil changes, inspections, roadside assistance. Well, that would be considered, even though the customer didn't have to pay extra for it, that would be considered above and beyond delivering a product of acceptable quality, right? That just goes above and beyond because it assures that that product will be in good condition for a long time. So in that situation, when we sell the car for $30,000, we have to somehow break out that $30,000 between the car itself and this warranty, additional free warranty. And we have to allocate the transaction price we'll recognize the revenue for the car today when we sold it and delivered it to the customer, and the warranty we would recognize over a period of 5 years. So just because it's not an warranty that's separately purchased doesn't mean it's not an extended warranty, although I will say in most times that is the case. If you want extended warranties, most times you do have to pay money for it. Okay, now let's talk about these things called options that are also considered to be separate performance obligation from the product or service that's being sold. An option is a feature of a contract that allows a customer to receive additional goods or services at no additional cost or some sort of a discount. And it's an option that would provide a material right, which is something the customer would not receive otherwise, so the seller is obligated to provide it. And the next slide will be the examples. It's a material right exists when the customer receives a future benefit that is incremental and not available to others, and it would be significant enough to influence the purchase decision. Let's go through some examples to make more sense of what a customer option, a customer option that has a material right to with it. So if you buy Windows and includes software upgrades, right? That's considered to be a separate performance obligation. If you have customer loyalty programs like frequent flyer miles, let's just say, right? Those loyalty programs have to somehow be accounted for separately by the company. If there's an exclusive offer, buy subscription and then you get 3 months at half price next year. How is that accounted for? Or if there's just like a discount feature services, buy a product today, buy today and get a phone upgrade once a year, right? Or there's just like a simple discount of buy this shoe today and you get a 10% discount. So let's go through kind of what this is. Options provide a material right, and the material right is something the customer would not receive otherwise, so the seller is obligated to provide it, right? The seller is obligated to provide the software upgrade with your Windows 11 purchase or whatever number it's on. The company is obligated to provide you a flight if you have enough frequent flyer miles. They're obligated to give you the 3 months next year at half price, etc., etc. So back to this, an option would be, or a material right exists when that future benefit is incremental. You have to have you can't have one without the other, right? You can't have that software upgrade without actually buying the software itself. And it has to be significant enough to influence your purchase decision. So usually people will be influenced by an additional option as to whether they're going to buy it or not. Let's go through an example, and I think it'll make a little bit more sense. TrueTech offers a promotional coupon with every TriBox it sells for $240. The coupon gives TriBox customer an opportunity to buy a headset that normally sells for $150 for only $90, a 40% discount. The coupon must be redeemed within 1 year of the purchase. TrueTech estimates that 80% of the customers will take advantage of the coupon, and now we have to prepare a journal entry to account for these 100 TriBoxes sold for cash under this promotion on January 1, 2027. So we sold 100 TriBox modules, right, for $240. So we received cash for $24,000, right? Times 100 equals $24,000. And what we have to do is we have to allocate this $24,000. Some of it is going to be allocated to the actual module, and some of it is going to actually be allocated to this discount that we have offered to the customer for this headset. So that's what we're going to go ahead and calculate. In order to do the allocate the the 24,000 to the discount, we have to know what is the standalone selling price of the coupon or of the discount. So we have to know what is the discount amount. And we're told that the discount is a 40% discount off of $150, which is $60, okay? Right? Because we sell for 150, we offer 90, the difference is 60. That's the discounted portion of the coupon, right? That's the coupon itself. It's the $60. But we're only going to sell 80% of it. That's what we estimate. So we're going to take the $60 times 80%, and that gives us $48. So now we have a standalone price for the tri-box module, which we know is $240. And now we have, well, I'll put this in quotes, like a standalone price for the tri-box coupon is $48. Now we're going to allocate it based on their pro rata, based on their standalone price. So we're going to take the standalone price of the module is $240, the coupon is $48, so the total is $288. The percent, how do you allocate that? For the modules, we're going to take their standalone price of $240 divided by the total $288, and we get 83.33%. And for the coupon, we're going to take their standalone price of $48 divided by $288, and we're going to get the 16.67%. Then what we're going to do is we're going to apply the selling price of $240 to each of those items, the modules and the coupon. So we take $240 times the 83.33% times we sold 100 units for the modules, and of the $24,000 that we've received, $20,000 is going to be allocated to the module, and we're going to do the same math for the coupon, right? The $240 selling price times the percentage allocated to the coupon of 16.67% times the number of units sold is 100. So $4,000 will get allocated to the tri-box coupon. Now we know how to do our accounting on January 1st when we actually sell those modules. We've received cash for $24,000. We recognize $20,000 of sales revenue for the tri-box modules, right? Because we've actually delivered those modules. So that satisfies that performance obligation, and therefore we can recognize that revenue. Now the $4,000, we have not yet satisfied that specific performance obligation. So we set up this liability for deferred revenue for the coupons for $4,000. But the question is, for this $4,000, when do we recognize that as revenue? And because, well, we recognize it when the performance obligation has been satisfied. And that's going to be when either the coupons are redeemed or when they expire. So whenever they make a sale, right, if someone sells it using that coupon, they will allocate a portion of that sale to and recognize revenue from that $4,000. Or if customers don't actually redeem 80% of those, then at the end, when those expire, let's just say they expire after 2 years, then they will just reverse this deferred revenue and recognize revenue on their income statement. Let's go through a concept check. Scale Company offers a promotional coupon with every product it sells. The coupon gives the Scale Company customer an opportunity to buy an electric drill that normally sells for $50 for only $30, which is a 40% discount. The coupon must be redeemed within 1 year of the purchase. Scale Company estimates that 80% of customers will take advantage of the coupon. What is the standalone price of the coupon? So make sure you read the questions. What piece of information is it asking for? So we're going to take the discount amount, which is $20, right? The $50 minus $30, and times the estimate. We estimate that it is the 80% of it will 80% of customers will take advantage of it, right? So $20 times 80% is $16, and that is going to be the standalone price that we will allocate to this specific coupon when we do the accounting for this transaction. Let's go to another concept check. Hooper Inc. offers a discount on an extended warranty on its smartphone when the warranty is purchased at the time the smartphone is purchased. The warranty normally has a price of $300, but Hooper offers it for $240 when purchased along with the smartphone. Hooper anticipates a 75% chance that a customer will purchase the extended warranty along with the smartphone. Assume Hooper sells 1,000 smartphones with extended warranty discount offer. What is the total standalone selling price that Hooper would use for the extended warranty discount? So let's just go through it instead of me reading that entire question. And so again, we need to know what the discount amount times the percent we think that will be actually redeemed times the number of contracts, which in this case is the number of smartphones. So our discount, the warranty normally has a $300 price, but Hooper's offering for $240. So our discount is $60. They estimate that 75% of the customers will actually purchase that extended warranty, and the number of contracts is 1,000, which gives us a standalone selling price for the extended warranties of $45,000.